Good evening, everyone. Thank you so much for joining us. We will start the webinar in a couple of minutes. Thank you so much for your patience. Hello, good evening, everyone. Thank you for joining us for today's webinar. I'm Simran, and I work with Tally Solutions for the Middle East region, and I'll be your host for this evening. As you all know, the news of UAE corporate tax is one of the biggest news after VAT. On 9th of December, the Ministry of Finance officially announced that corporate tax on business profits will be applicable from 1st June 2023, and most businesses will become subject to the UAE corporate tax. We understand that you will be eager to know more about this compliance norm and its impact on your business. Before we start, let me take a moment to thank our event partners, Cefi Computers, who are certified gold partner of Tally, and Anderson for accepting our invite to join and contribute to add more power to the SMBs in the country. Just some ground rules before we get started to ensure a flawless experience. All the participants will remain on mute throughout this session to avoid any noise disturbances. Please be informed that we are recording the session and it will be available as an on-demand webinar. I apologize in advance for any network interruptions that may occur. However, we will try our best to make this experience seamless. I'm sure you would have a lot of questions during this discussion. Please type them in the Q&A panel of your Zoom control, and we will bring them up towards the end of the session. We are glad to see so many of you join us here on this platform, and we would love to know a little bit about all of you. So please take a few seconds of your time to answer the poll that will be on your screen right now. We'll take a couple of seconds so all of you can let us know about yourselves so we can make this session more interactive and more catered to your requirements. And now let me start and let me invite and introduce CA Pratim Sen Gupta, who will take us through this session. As an associate director, Pratim leads the direct tax practice at Anderson in the United Arab Emirates. He's serving a diverse client portfolio in this region and has close to 11 years of experience in providing solutions in all facets of corporate and international taxation matters to a diverse client portfolio at large multinationals based out of India, USA, Japan, Spain, UAE, and Australia. Pratim has extensive experience in leading direct tax assignments involving tax compliances, advisory, structuring, representation before tax, government authorities, and tax litigation. His key expertise is in impact assessments of new legislations, mergers and acquisitions, tax deductibility of various expenses, nuances around tax losses, taxability of cross charges amongst related entities, and others. Pratim has also presented and contributed on international and corporate tax matters and updates on external forums. He's a chartered accountant and a member of the Institute of Chartered Accountants of India. Today, Pratim will speak about the corporate tax law and how it's going to impact businesses at large. Over to you, Mr. Pratim.
Thank you, Simran. Am I audible?
Yes, you are audible.
Yes. Let me just share my screen before I begin to present. Is my screen visible?
Yes, Pratim, it's visible.
Hello, everyone. So finally, we all have our hands on the final law, the corporate tax law. We had to wait around 6 to 6.5 months for this ever since the public consultation document was released. While this law was, has been anticipated, it's a landmark event for UAE, especially because, this is, an unseen law and it's something new and novel to this land. In terms of the law itself, we need to wait for certain regulations to also be allowed because to be published because the law refers to a lot of regulations and cabinet decisions. So we need to wait for those for some clarifications. And also the law covers most of the aspects that were mentioned in the public consultation document, apart from a few. One of the key ones being the general anti-abuse provisions, or GAR as we call it. The basic purpose of a GAR provision is that any transaction that is entered into for getting a tax advantage, tax authorities will have the power to dismiss those transactions and bring those transactions to tax. This is widely been legislated into domestic tax laws across the globe. UAE has followed suit, and they have done this with the purpose that because this law is new, and entities would be restructuring the business. We need to see how this will be impacting businesses when they want to comply and go forward with this law. With this, I begin my presentation with the timelines. Of course, everyone would be aware that in January of 2022, the government had announced that they would be coming up with a corporate tax law. In April, they had released a public consultation document. And just last week, they had come out with the final law. In terms of applicability, this law will be applicable from 1st June 2023, and for all financial years that begin on 1st June 2023 or after 1st June 2023. Most businesses in UAE follow a Gregorian calendar system, so that's January to December. That means if you're following the same, the first tax year would be 1st January 2024. But as an alternate example, if you're say following tax year of say September to August, then your first tax year would be first September 2023, as against 1st January 2024 for other businesses. Before I get into in depth into the details of what the tax law says, just the fundamentals. Any revenue act, by revenue act I mean a tax act, has 4 key principles, and those principles or pillars are who to tax. By who to tax, I mean who all will be covered under the tax regime. What to tax. What to tax means what kind of income of those persons would be taxed. At what rate to tax them, that's the rate which will be applicable, and how to tax them. By how, it refers to the computation mechanism that will be used to calculate a taxable income and how do you arrive at it. These are the 4 pillars. The UAE corporate tax law deals with all 4 aspects, and I'll take you through that. Now, coming to the first aspect, that is the rate of taxation, everyone would be aware it's 0 and 9%. 0% for taxable income that does not exceed 375,000 AED. If it exceeds 375,000 AED, it would be 9%. And by exceeding, it means that if you have, say, 400,000, the 9% would apply on 25,000. Now, I say 375,000 with an asterisk because the final law does not mention a threshold. These thresholds come out of the FAQs. Even the PCD, the public consultation document, had alluded to this threshold. We are assuming it would be the same when the regulations are out, but we have to wait and watch. There are also tax rates that have been legislated for free zone persons. That is 0% on qualifying income and 9% for non-qualifying income. I will get to what qualifying and non-qualifying is when I deal with free zone persons in the later part of my presentation. One point that is very interesting to take away from this is that the public consultation document had indicated that large multinationals may be taxed at a higher rate of 15%. This comes from BEPS or the OECD Pillar 2 project, which wants to apply a 15% global minimum tax on large multinationals. However, the law does not have such provisions. It is anticipated that soon UAE would come out with these rules and regulations for large multinationals as well for a 15% tax. And by large, I mean a revenue threshold of euro 750 million or 3.15 billion dirhams. But up till then, up till that legislation comes into place, those large corporates will have to follow the normal 0 to 9%. Now, coming to a very important pillar that I had spoken to, who is going to get taxed? Who are the people that fall under the ambit of this Corporate Tax Act? So the legislation has defined that there will be 2 categories of persons, one resident and one non-resident. Resident has been defined very widely. It includes a juridical person, incorporated, established, or recognized in UAE. Juridical person has been clarified in the FAQs to mean any legal entity that has an identity of its own. By identity of its own, it means separate from its owners. So normally a company or an LLC would be a juridical person. A foreign company or a legal entity would also be considered a resident if its effective place of management and control is in UAE. This effectively manage and control is a concept called place of effective management, or POEM as we tax experts call it. Uh, this has been legislated, but a lot of other countries that have this POEM rule have detailed rules behind it, supporting it to determine how you, figure out that whether a foreign company has a place of effective management, in this country or not. But we need to wait for those rules. Firstly, we need to see whether those rules come out with the regulations or not, and let's see whether UAE comes out with them. Otherwise, just leaving it here would be a very subjective matter. A natural person means a person like you and me, would also be subjected to corporate tax if we carry out certain business or business activity. The exact business or business activities has not been specified. The regulations are yet awaited as to what all business activities would be covered. If you or me carry out those businesses, we need to wait and watch for this. And free zone persons would also be covered as residents, and even a branch of a foreign company, a branch in a free zone of a foreign entity would also be covered under the definition of resident. A non-resident would only be covered if it has some sort of a presence in the form of a PE, a permanent establishment. A lot of you would be aware of this concept, and the definition of permanent establishment has been borrowed from internationally accepted rules and regulations around it. The few kinds of PE that has been covered is a fixed place PE, dependent agent PE, and a construction PE. Other than just a PE, a foreign company or a foreign entity could also be taxed if it has state-sourced income or if it has a nexus in UAE. State-sourced income has been very widely defined. It covers all goods that are sold within the state, or any contracts executed, any services utilized or rendered within the state. It's quite wide, and that brings me, a thought remains in my mind that if state-sourced income is so widely covered, then what does UAE intend to cover under nexus? We need to see what they mean by nexus, and how wide would the ambit or the scope of nexus be, and how many foreign companies would be covered under the UAE corporate tax regime due to that. Coming to basis of taxation is a fancier way of saying that if you're covered by the corporate tax law, then what income would be taxed in your hands? Where domestic, international. But so if you're a resident, simple, your global income would be taxed in your hands, whether you earn it in UAE or any other GCC country, or any part of the world, it would be taxed in UAE. Similarly, for a natural person, if they carry out the business or business activity in UAE, all the income related to that business activity would be taxed in UAE. By that, it seems like personal income would not be covered under the corporate tax regime, and the PCD had alluded to some kind of personal income that would be any kind of personal rental income, or any kind of personal dividend income or interest income would not be subject to corporate tax. Non-resident would only be taxed when there is some income that is attributable to the PE or the nexus in UAE, or it is a state-sourced income. Now, when I spoke earlier, I spoke about resident and non-resident, and if you're resident, or non-resident, what kind of income can be taxed? There are some exemptions that have been provided in terms of who will be excluded from this legislation. And the list is quite similar to what was there in the public consultation document. So if you're a government entity or a government controlled entity, and you do not require a license to conduct any kind of activity, or you don't carry out a mandated activity. By mandated, we need to wait for the list, but it seems like it would be some sort of a sovereign function. So you would not be an entity that would be subjected to corporate tax. Similarly, for entities that are involved in extractive and non-extractive natural resource business, an exempt person would also cover qualifying benefit entity, that is any charitable or any religious institutions, any qualifying investment fund, any private pension or social security fund, or any other juridical person that are controlled by such exempt entities. I move on. I spoke about free zone. The PCD had mentioned that free zones would be taxed at a beneficial rate of 0%. But if you don't meet those conditions, it would be taxed at 9%. The final law, brings out a different concept. A final law brings out a concept of a qualifying free zone. A qualifying free zone is any free zone person that maintains adequate substance, that derives a qualifying income, that does not elect to be a normal CT paying person and complies with transfer pricing provisions. So coming to the second point of qualifying income, this is very important. So they said, if you're a qualifying person having qualifying income, on that qualifying income, you can have a 0% rate, but you can also have non-qualifying income and get that taxed at 9%. So that means the same free zone person can have mixed activities. And those mixed activities can generate a qualifying income and a non-qualifying income, which is quite different to what the PCD had hinted at, because the PCD had said that if you don't meet the conditions, your entire income would be subjected to normal tax. The maximum benefit or the years for which you can get this benefit is for 50 years. And also, like I mentioned, a free zone person can also not go for the 0% election and can elect to, get taxed under the normal CT regime. That would be getting taxed, at 0 or 9% based on the thresholds of 375,000. Unlike the PCD, it doesn't see, the final law doesn't make this option or this election an irrevocable one. And just before I move on, we need to also weight what a qualifying income and a non-qualifying income is. They have not defined it. As I had mentioned, we need to wait for a lot of regulations to come out. We will get an idea as to what qualifying and non-qualifying means once those regulations are out. Coming to exempt income, I had mentioned that worldwide income would be taxed and income related to the business or business activity would be taxed. But there are also some exemptions given to incomes. The first one is domestic dividend. By domestic dividend, I mean any dividend or any profit distribution done by a resident UAE legal entity, that is exempt. No conditions attached, it's exempt. Now, when it comes to foreign dividend and capital gains on shares, those capital gains on shares doesn't have to be domestic. Foreign. It can be either arising of the sale of shares of domestic entities or foreign entities. So foreign dividend and capital gains on shares would have certain conditions attached to it if you want the exemption. And those exemptions are called participation exemptions. Like the name suggests, participation meaning you need at least some sort of a participation in the ownership, in the liquidation proceeds, or in the profit. That participation is 5%. You need at least a minimum 5% interest. You need to hold this interest for at least 12 months or have an intention to hold this for 12 months. I will explain the nuances of this through an illustration in the next few slides. The investee entity, that is the entity that you invest in, has to be in a jurisdiction where there's at least a corporate tax of 9%. And there are also some anti-abuse provisions that have been provided if you route the investment through an intermediary. One very important condition is that if your investee entity, that is the entity that you've invested in, that you hold 5% in, if it gets a deduction of this dividend that has been distributed by it, then the entity that is receiving this dividend would not be eligible for the exemption. Any foreign exchange or impairment, gain or loss that is related to this 5% interest would also be exempt. Now, a UAE resident also has an option to exclude its foreign PE income, that is permanent establishment income. So if a foreign resident company has a permanent establishment and a branch is a permanent establishment. So if any UAE company has a branch outside UAE, it could elect not to include that branch's income within its tax computation, but subject to the fact that that branch is located in a jurisdiction where the corporate tax rate is at least 9%, and any tax that has been paid in that foreign country will not be eligible to be taken as credit in UAE. Also, non-resident entities that are operating in aircraft and shipping enterprises in international traffic would also be exempt under the corporate tax regime. Now, coming to participation exemption, I want to run by some illustrations to clarify some of the provisions. Now we have one mainland entity. It holds 4% interest in a UAE company. It holds 10% interest and shareholding in an Indian company. And India, we all know that the tax rate is 25% plus, and also 100% of the interest in a Bahamas country. And Bahamas, just to let the audience know, doesn't have a corporate tax regime. This interest is held by the UAE entity for at least 12 months. Now let's look at how the participation exemption would work. Now, a UAE company, is in UAE. Any kind of dividend that is received would be considered domestic dividend, so it's exempt. I don't even have to look at the conditions. For capital gains, I have to still look at it. Because my shareholding is less than 5%, it will be taxable. Now coming to India, any dividend received from my Indian entity, I have to look at the condition because the dividend would be foreign, and even the capital gains would be a foreign capital gain. Now I hold 10%, above 5% required. India is in jurisdiction above 9% tax regime. Both would be exempt because I satisfy the conditions. Now Bahamas, 100% is above 5% holding required, but it has no corporate tax regime, so I don't fulfill the criteria, and both dividend and capital gains would be exempt. Now coming to the second illustrations, which deals with the period of holding of 12 months. Let's say in tax period 1, I have a UAE mainland entity that acquires shares of an entity on December 1st, 2024. Now, this share has been acquired at a 10%, so I hold 10% of this entity. Now my tax period is January to December. My first tax return, my tax return would be due in September 2025. Now, when I'm filing my tax return, 9 months have only elapsed, 12 months hasn't. But yet, because the law says that, you can claim an exemption if you have an intention to hold that interest for 12 months. In my tax return, it appears that I can still consider that dividend. If there's any dividend declared, I can consider that dividend to be exempt in my tax return. But if now, suppose I sell those shares in October 2025, 1 month after my my tax return is filed, I don't actually satisfy this 12-month criteria, and this will now, will now be taxed in my tax period 2. So it will be brought to, so what I claimed, as exempt for my, tax period 1, that is year ending 2024. Now that same income will be taxed in my hands in year ending December 2025. Now moving on, computation of tax payable. So the tax law mentions that the starting point of your tax computation would be the net profit as per your financial statements. The financial statements are required to be prepared as per the acceptable accounting standards in UAE. Most people prepare their accounting on their books on the basis of IFRS. So we'll see a lot of IFRS being adopted. So after you start from there, and then you make certain adjustments. I'll just come to the next slide. So those adjustments could be unrealized gains or losses, that is unrealized gains or losses on certain assets and liabilities. Exempt income, I have covered that. Certain reliefs, which I'll cover a bit later. Deductions, which are again, deductions means, deductions for various expenditure. I'll come to that. Transfer pricing adjustments. So if you don't follow transfer pricing provisions, they can, you have to make an adjustments in your income, taxable income. There are some losses that you can set off. There are other items also, like say qualifying business activity and other items which are yet to be specified in separate regulations. You need to wait for that. Right now, we don't have much clarity on those items and how those would form part of a tax computation. After you make these adjustments to your net profit, you come to your taxable income. Now you compute 9% or 0%. So if this taxable income is above 375,000, you compute 9% tax on that. And then whatever figure you get, you reduce your withholding tax credit, your foreign tax credits, and come to your tax payable amount. Now, this taxable income, the law states has to be computed on accrual basis, and cash basis is only allowed if permitted by the authority. There are some, going to be some regulations around permitting certain kinds of individual entrepreneurs or small businesses to prepare their financial statements on cash basis. Now, coming to deductions. Deductions are, there's a general, sorry. So there's a general provisions regarding deductions or any kind of expenditure would be allowed if it's wholly and exclusively incurred for the business. And mind you, this is business of that very entity, not the business of any other sister entity or a sister concern. That expense has to pertain to that entity or company to itself. The expenditure cannot be capital of nature or personal in nature, and it cannot be incurred to derive any kind of exempt income, because the logic is that if you're earning any kind of exempt income, it's anyway not, you're not getting taxed on it. Why should you get a benefit of an expense deduction from? If you incur any kind of expenditure which is dual in nature, say an expenditure which is exempt in nature, which has been incurred for deriving exempt income and for deriving taxable income, that would be deductible on a proportionate basis. The law, while laying down this general rule for all expenditures, has specified certain kind of expenditure that will not be allowed. That is donations, grants, or gifts to not that are made to not a qualifying public benefit entity. Any kind of fines or penalties, excluding compensation for breach of contracts. This is the across the world, breach of contracts is not looked upon as a penalty. It is a contractual obligation. So it doesn't form part of fine or penalty, and UAE followed suit. Any kind of recoverable VAT, you will not get a separate deduction for. Entertainment, amusement, or recreational expenses incurred for customers or shareholders or other business stakeholders, you would get a deduction of only 50%. Any bribes or illicit payments, no deduction. Dividend, profit distribution, of course, you will not get a separate deductions because those are distribution of your already paid profits, already tax paid profits. Any withdrawals from businesses, any tax that you pay in UAE corporate tax or any kind of similar corporate tax that is paid in for outside UAE, you will not get an expense deduction for it. Interest deduction is also subject to some capping. I'll get to that in the later part of my discussion. So now, yes, interest capping. Interest has been widely defined, and it covers interest on borrowings. And the capping is on net interest. By net interest, I mean your interest expenditure less your interest income. And this net interest would be allowed up to a 30% of your EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. And while calculating this EBITDA, you have to exclude your exempt income. So regardless of whether you are incurring this interest for any taxable or non-taxable income, your interest will not be allowed on, your interest will never be allowed on exempt income. So from the calculation of EBITDA, you have to always exclude exempt income and then arrive at a 30%, and then you need to see how much interest you can take a deduction of. Either this 30% capping applies, or there is also a threshold that will be specified that up to which you can take a interest deduction. This threshold is also supposed to be specified through a regulation. This capping is not applicable to banks and insurance providers, and also, it's a welcome relief to natural persons. Also, it will not apply if they're carrying out a business of theirs. The interest. So what happens? So say in year one, you have an interest of 100 and only 75 is allowed. What happens to a 25? The 25 has to be carried forward to next year and it will form part of the interest deduction of the subsequent year, that is year two. And this interest can be carried forward for 10 years. So they're allowing businesses to carry forward for 10 years. That's quite a long period. Now, what about groups? I'll come to tax grouping later on, but the law says that there could be specific rules and regulations and limits that may be specified for tax groups. We have to wait and watch on this aspect. And sorry. And regarding interest to related party, paid to related parties. So if you have borrowings between related parties, no interest would be allowed if that borrowing has been used for any kind of profit distribution or dividend distribution, any kind of share capital redemption or repurchase, any kind of capital contribution to a related party, any kind of acquisition of shares of an entity, and that entity becomes a related party. If that borrowing has been used for any of these purposes, it will not be allowed. No interest would be allowed to that entity. And this also has a rider. The main rider being that if the main purpose of this borrowing is not to get a tax advantage, then such interest would be allowed. They have not defined what this how would you determine this tax advantage. Tax advantage gets a mention in the general anti-abuse provisions, but we have to see whether we can borrow the definition from there. But also this tax advantage would deem to be fulfilled, or it would be deemed that you satisfy that you're not taking this borrowing for a tax advantage if the related party is all located in a jurisdiction which has a corporate tax of at least 9%. So coming to tax losses, as you would be aware, would only would arise if your expenses or your reliefs exceed your income, taxable income. Now, as it's quite a progressive regime that they have come out with. Usually, countries across the world, have a limitation up to which you can carry forward. By limitation, I mean, if you can, if you're not able to set off certain losses in year one, you can only carry forward those losses for say 6 years, 7 years, 8 years. But in UAE, you can carry forward those losses indefinitely. So if you have a loss in year one, you can carry it forward hypothetically, and set it off against the income of year 10 as well. But only up to a limit of 75% of that year's taxable income. So say you have a loss of 100 and you have a taxable income of 100 again in year two, you can only set off 75. The balance 25 has to be carried forward. One more key aspect is that any loss that that was incurred by a business prior to the law becoming effective, or prior to that such person becoming, being covered by the law, or those losses arising from any exempt activities, those losses cannot be carried forward and set off. Those become ineligible. So that's a big hit on some companies and some entities that have had losses up till now. Those losses appear to be ineligible to be set off against any income. So, there's also certain other limitations. If an entity has a loss, say in year one, and it's trying to set off its losses in year four, but its shareholding has changed by more than 50%, then those losses will not be allowed unless after the change of shareholding by more than 50%, the same or similar line of business is carried out even after the shareholding change or the ownership change. But same or similar, the various rules given out how to determine whether the same or similar business is being carried out, and one would have to see whether they meet those criteria or not. Now, what happens, I'll get to tax grouping later, but what happens when you don't form a tax group? If you have multiple entities within UAE and you have a common shareholding amongst those entities of up to 75%, and those entities are not exempt and are not qualifying free zone entities, and all those entities follow the same financial year and prepare their books on the similar accounting standards, you can set off the losses. One key part is that that common shareholding that I spoke about, that 75%, should exist on the year that loss was incurred up till that year in which the loss is being set off by the other group entity. So one entity can transfer to the other entity and can set it off as long as the common shareholding has existed in both those years. So coming to tax group, I think a lot of the audience would be familiar with this concept of tax grouping. Any UAE juridical person can form a tax group subject to the key condition that it directly or indirectly holds 95% of not only the ownership and voting rights of other UAE resident juridical persons, but also the right to net assets and profits of that entity. So this is something different from the public consultation document, where public consultation document had alluded to only ownership and voting rights. They brought in an extra rider of net assets and profits. Also, similarly to the previous conditions, none of the entities that want to form a tax group can be exempt entities or can be qualifying free zones. And again, the financial years have to be aligned. They have to be the same, and the financial statements have to be prepared on similar accounting standards. Now, what are the advantages of forming a tax group, right? So the advantage is, once you form a tax group, you have single compliances. By single compliances, I mean a single taxable return filed by the parent, make a single tax payment, and it appears the parent has to obtain only one single registration for the tax group. To form a tax group, an application has to be filed with the FTA, and this application has to be filed by the parent and all the members of the tax group. And there are various rules and regulations that specify when a subsidiary or a member group or a member entity can enter the group or exit the group, or when a tax group stands dissolved if those conditions are not being met. Now, coming to the computation of the income of the tax group, like I said, single tax returns, how would it be computed? In a consolidated manner. All the intercompany transactions would be eliminated, and a consolidated income and expenses would have to be computed to derive the taxable income. From the FAQs have also mentioned that if you form a tax group, transfer pricing may not apply to that tax group. So that's one key advantage, again, of forming a tax group. I'll come to transfer pricing, but transfer pricing is something which is, it requires a lot of deliberation, and a lot of compliances, and this could be a welcome relief to a lot of tax group. Any income, say, that has not been considered in the income of a tax group because there were intercompany transfers of assets or liabilities, if a member group that has transferred this asset or received that asset, if they leave the group, if they leave the group within 2 years, such income would also have to be included into the tax group's income. Now, what happens to losses? When you form a tax group, obviously, losses would have to be consolidated, but they have come out with some specific rules as to, when a new subsidiary that joins a tax group, their losses, say they had some pre-existing unutilized losses, when they join a tax group, that would form part of the losses and would get added to the losses of the tax group. However, in the reverse scenario, when say if the subsidiary is joining a tax group but doesn't have losses, but it has income, that subsidiary's income cannot be set off against any old or unutilized tax losses of the tax group. So that is a bit of a limitation. What happens when the tax groups get disbanded or ceases to exist? So if a tax group ceases to exist, if there's some unutilized losses there, and if the parent entity still continues to exist as, after a tax group ends, all those losses would lie in the hands of the parent entity. Or if the parent entity doesn't exist anymore, then the losses get lapsed. Other than those losses that existed in the hands of the subsidiary or the member group prior to joining the tax group. It's a bit complicated, and the laws are quite complicated. And after the session, if anyone has any questions, I can take this on separately. Now, just a brief example and illustration about tax group. Just, we have a UAE mainland entity holding 94% of another UAE mainland entity. It holds 100% of another UAE mainland entity and 100% of a qualifying free zone. Now, for the UAE mainland entity that's appearing on your left, because the 95% shareholding has not been satisfied, it cannot be part of the tax group. The branch of the UAE mainland entity that's appearing on the center would be considered as part of that main entity itself. And because this is held up to 100%, it can be eligible to be part of a tax group. Qualifying free zones cannot be part, but if the qualifying free zone entity elects to be taxed at regular CT rates, then it stops being a qualifying free zone, and then it can be part of a tax group. So if it elects, then both the qualifying free zone, it's no more a qualifying free zone, but if it makes the election, then that free zone entity and the UAE mainland entity can form a tax group. There are some relief given to intergroup transfers and transactions. So if there's any assets or liabilities that are transferred within between group entities and group entities, very similar conditions again, common ownership of 75%, can't be exempt entities, can't be qualifying free zone entities, same financial years, books have to be prepared on the basis of similar principles. If you satisfy these conditions, you become group entities, and any assets or liabilities that are transferred will not be considered for the purpose of your tax computation. But the key condition here is that it will be assumed that these transactions are carried out at net book value, and the value of this consideration would be also at net book value. The logic behind this is because you're giving your tax neutrality. The tax neutrality, they're not taxing this transaction. You will also not get the benefit of a higher cost. So the purchaser will have to take on those assets at book value, will not get the advantage of a higher cost, and will not get the advantage of a higher depreciation also from this transaction. If, say, tomorrow, within 2 years from the transaction, that group entity leaves the group, then this income would be taxable would become taxable, and especially in the year in which the group entity leaves this tax group. What would be the income that would be taxable? Again, the earlier transaction was assumed at net book value. When you leave the group within 2 years, the transaction would be assumed to be at market value. They would bring up the value of the transaction and tax that income in the year in which the group entity leaves the group. Just a simple example, a holdco outside UAE holding, it holds 100% directly in UAE mainland entity, then it directly holds 75% of UAE mainland co 1. And if you see the whole co, through this 100% holding in UAE mainland entity, also actually holds 25% indirectly in UAE mainland co 1. And it holds indirectly 75% of the holding in UAE mainland co 2. Now, UAE Mainland Co 1 and UAE Mainland Co 2 satisfy this 75% common ownership criteria, and any transfer done between them would be not considered taxable. Transfer pricing, very important concept which has been introduced. Basically, any transaction or any arrangement that are done by between related party and connected persons would have to be at arm's length. Connected persons, and I'll come to connected persons definition later, but related party has been defined very widely. It could be common control. It could be a shareholding of about 50%. It could be a relationship to fourth degree. So it's again quite wide, and it captures a lot of relationships. And and I use the term arm's length. Arm's length in layman's terms means that those transactions between those related parties would have to be done at a price similar to what a third party transactions would be carried out at, like a market value. In the law, various methods have been prescribed, borrowed from, internationally accepted regulations to use these methods. You can also, use multiple methods to arrive at the price. By methods, basically these methods would be used to determine, so if you have a related party transactions between, company A and company B, those methods will be used to determine the price between those transactions and what price they should be at. If you don't have those transactions at arm's length, then the tax authorities can make an adjustment to your income. And the law does provide for a corresponding adjustment. Corresponding adjustment simply means that if it's an income in the related party's hand, it could be an expense. It could be, an expense could be given in the other related parties' hands, in whom, with whom the transactions have been carried out with. TP applies to all. By all, I mean, usually transfer pricing is applicable, for international or, international transactions between related parties and sitting, say, in a, UAE and a related party that would be sitting in, say, KSA. Usually transfer pricing applies to such transactions. And by all, I meant it also now, it appears that it also covers domestic transactions. So if a UAE entity is having transactions with another, a group entity within UAE, transfer pricing would be applicable on that transaction. So it's domestic and international. A free zone entity transacting with a related party that is in mainland, transfer pricing would apply. You'll have to, comply with those regulations. Also, transfer pricing would apply between, I mentioned some exempt persons, the government and government control entity. Between exempt businesses and non-exempt businesses of such exempt persons, transfer pricing would apply. Now, coming to connected persons, who are connected persons? Connected persons are any person, who is an owner of a business, who's a director or officer of that entity or company, or any related person to such owner or director, or if it's an unincorporated partnership, then partners of that partnership or their related party. Now, what happens when you make, so the law says that if you make a payment or a benefit provided to such connected person, that payment or benefit is to be, is to be allowed as a deduction only if it, that payment or benefit corresponds to a market value of the service or benefit provided by that connected person. So this may have a big implication on a lot of businesses in UAE that are making payments to their directors, are making payments to their owners. Now you will have to prove that those payments or benefits that are being given are firstly wholly and exclusively for the business, and it corresponds to the market value of the service that such directors or owners are providing to the business. How do you determine market value? Again, you have to refer to the transfer pricing regulations and bring it at arm's length. Any payment that is above this market value would not be allowed as deduction. So say just simply as an example, If you're making a payment to your owner, that is, just for a service, or any kind of any director remuneration. Say the market value that is determined is 1 million, but you're paying 2 million to them. The additional 1 million would not be allowed as a deduction to the business. This may have far-reaching consequences. Now, what happens when transfer pricing applies to you? You will have to do transfer pricing compliances. These compliances are mainly in the nature of documentation. One additional thing that has been mentioned in the in the final law, which is a departure from the public consultation document, is a disclosure form. A disclosure form would also have to be filed along with the tax return. They have not specified the content and the manner in which the form is supposed to be filed. Regulations are yet to be out for that. Apart from this, an entity would also have to file a local file and master file. A local file is nothing but a documentation that firstly, local file is applicable to every entity. So say in a group, you have 5 different entities within UAE and TP applies. All 5 entities have to file a local file if TP regulations apply to you. And it's nothing but, you'll have to just, it captures the nature of activities and the business carried out by the entity, a profile of that company, the broad nature of the related party transactions, and the methods that were used to bring those transactions to an arm's length, to bring it to a market value, basically. And a master file is filed at a group level. And again, like in my example, if it applies to it, only one master file has to be filed other than 5. So it applies at a group level. These local files and master file usually don't have to be filed along with the return. It has to be maintained, by the entity and can be called for within 30 days. So if it's called for by the tax authorities, you have to submit this local file and master file within 30 days of these being called for. Now coming to the currency that is important, like there'll be financial statements that are prepared by businesses or forms that will be filled in. All the denominations or every currency amount has to be in dirhams. If it's not in dirhams, then it has to be converted as per the currency, foreign currency rate that is set by the central bank in UAE. What is important, what we need to wait for is more detailed regulations around, when you do those, conversion at a date of booking the transaction in a system or date of payment. Those regulations need to be out. In terms of withholding tax, excuse me, withholding tax has been legislated. I mean, it's part of the corporate tax law, but it's been kept at 0. This gives an indication that, there may be, certain transactions, the government may prescribe a certain withholding tax rate for sometime in the future because it already forms part of the law. An entity on whose income withholding tax has been done, this is for any future year, can claim a withholding tax credit. Foreign tax credit, so a UAE company has a branch outside UAE, and it includes that branch's income in its tax return, while computing its income. Now the branch has paid certain taxes in, say, assume the branch is in KSA, it has paid certain taxes in KSA. It can claim a credit of that tax in UAE while filing its return in UAE, subject to the limit of the tax, the taxable amount payable in UAE. So say the tax amount payable on the same income is, say, 10, but the tax is paid outside UAE is 15, you would only get a credit of 10. The remaining 5 you will not get a credit of. Neither can you take this credit as a carry forward for future years. CT return dates and tax payment dates have been kept same to what was indicated in the public consultation document, that is 9 months from the end of your taxable year. So say if your first taxable year is December 2024, it's ending on December 2024, then your first return would be due on 30th September 2025. Similarly, you have to make the payment on 30th September 2025. It appears that a free zone, a qualifying free zone person, even though they may be subjected to 0% tax on their qualifying income, they have to file the tax return. Coming to certain other aspects, there are some regulations around tax registration and deregistration. So any taxpayer would have to obtain a tax registration. This tax registration would be separate from the registration that you already have for your VAT. A separate application needs to go in. And if your business ceases, then a separate process has been incorporated in the legislation for a deregistration also. Your financial statements have to be submitted to the authority if they're called for. There are certain regulations that are awaited for a certain category of persons that would have to have their financial statements audited or certified. This is very critical. We need to look out for this regulation and for whom it applies, because this might have far-reaching consequences to a lot of businesses in UAE, where if you fall under this list, you have to now start getting your financials audited or certified. Record keeping, this is also very important. So if you file a tax return, you have to maintain your records for at least 7 years from the end of that period. So the tax authorities can call for the records up to 7 years. This gives me a hint of some timelines as to tax assessments or audits. It may be so that tomorrow they may come up with regulations that they could go back up to 7 years and carry out a tax audit, because you have to anyway maintain records for 7 years. So you have to look out and watch out for that. An exempt person who claims to be exempt should also maintain the records, substantiating that they're an exempt person for up to 7 years. Now, the next point is very important. Say, there will be gray areas, there will be interpretation issues, that are arising out of this corporate tax law. And if you have already entered into a transaction or you're entering into a transaction, either ways, you can approach the authority to get a clarification on the taxability of the transaction or arrangement. APA's advanced pricing agreement, these are certain agreements that are used for transfer pricing, that you can set the price between two related party transactions beforehand at an agreed price. These also seem to be covered by these clarifications, but we have to wait for more detailed rules for this. International agreements, by international agreements, I mean tax treaties. The law says that if any term of terms provided in a tax treaty that UAE has entered into with another country, if those terms are inconsistent with the domestic law, then the tax treaty shall prevail. Now we need to see how this inconsistency is interpreted, because usually, tax treaties are, referred for more beneficial tax treatment to a certain transaction. Now we need to see whether inconsistency would be equal to beneficial or not. This will be an ongoing development. Now, transition and closing provisions. The law says that, say your first taxable year is 1st January 2024. The law says that the closing balances as on December 31st, 2023, the closing balances have to take account transfer pricing. This could have a significant practical, practical challenge for a lot of businesses. What does that mean? So your balance sheet may have receivables, from related parties going back several years, 3, 4, 5 years. Are businesses now required to do a transfer pricing study for all those past years, and then adjust those transactions to market value, and then revise their closing balance sheet items? This could have a significant implication. We need to watch out for this. I mentioned GAR. GAR is the General Anti-Abuse Regulations. It basically seeks, any transaction or any arrangement that has been entered into to gain a tax advantage and not done for any commercial reasons, may be subjected to these GAR rules, and the tax authorities, if they see that these transactions have been purely done to get a tax advantage and there is no commercial rationale for doing it, so they can disregard this transaction. By disregard, they can completely recharacterize this transaction and bring this to tax. And scrutiny and penalties would be done as per those tax procedures law. One can refer to that. With this, I come to my concluding remarks as to what the next step is. The next step for businesses would be to do an impact analysis, that is to identify. See, the law is, provides a lot of details about what is taxable income, what are deductions, what you cannot take as deduction, some conditions regarding, claiming exemptions and things like that. You would have to do an in-depth study on how it impacts your business, because this 9% would be a significant impact on all businesses, and we recommend that everyone carries out an impact analysis. One would also have to look at the current IT system or the technology. So the reporting, the ERP, what kind of reports come out, and what kind of chart of accounts that they're maintaining. Once the forms are out for the returns, we need to see whether that whether your current ERP or your current accounts are capturing all the information and data that are required to carry out the compliances. Transfer pricing, again, businesses need to identify all the related party transactions, need to carry out a detailed transfer pricing study, see whether those transactions are being carried out on market value or not. If not, they need to do a detailed, benchmarking study. By benchmarking, basically bringing those transactions to a market value. If not, they could be facing adjustments on their income if they do so. Implementation, of course, once these things are highlighted, each business would have to implement those change, align their technology, align their accounting according to the corporate tax law. And compliances, of course, the compliance dates I have mentioned, and one needs to be regular with those compliances, and those compliances are just not a tax return. Those compliances would include also transfer pricing documentation, that's a disclosure form, and local and master file. With this, I end my presentation. I see that there are a few questions that have been posted. I can go through a few and answer and take up a few. And okay, let me just go. Simran?
Yes, Pratim. Thank you so much
Yeah.
for that great presentation. But before you take the questions, before we move on to the Q&A session, we would love to hear the feedback from the audience who are attending on how the session was and what more we can do for all of you in creating awareness around this compliance form, and what would you be interested in listening from us. So I would just like to launch a quick poll for everyone to let us know their next interests, and meanwhile you can have a look at the questions and answer them. Great. Thank you so much, everyone, for responding. And we'll definitely get back to you with more sessions on more topics related with corporate tax. Meanwhile, Pratim, you can definitely take up the questions that have been posted.
Yeah, I think some, I can't take up all, but I'll take up a few which, and for the remaining that I don't take up, you can, we'll reach out to you directly. Yeah, one question that I got, whether a non-resident branch in free zone will be considered as a resident person. Yes, If a non-resident has a branch in a free zone, they will be considered a resident person. This could create a lot of complexities in terms of dual residency. One way to break this dual residency would be a tax treaty. If this is a scenario that you have, we can deal with this. We can touch base later on. Whether an offshore company will be regarded as a qualifying free zone, we need to, so an offshore company, again, I think only if a branch is there in a free zone, I think it's related to the other question. How do you define year-end applicable to an entity? Can it be changed? So see, the tax law says that the financial year that you're following would be your tax year as well. If you want to change your financial reporting year, you can do so subject to the condition and requirements in the company law that applies to you. If you change it, then that would be your taxable year. Whether rental income from real estate in mainland held by Javza offshore company would be exempt. This is, this would depend on what a qualifying income would be. So if the rental income from mainland is considered a qualifying income, it would be 0% tax. It's not exempt. See, exempt is different from 0%, and exempt would be completely out of scope of corporate tax. But if it's a qualifying income, it would just, 0% would apply to it. But if it's a non-qualifying, 9% would apply to such income. Whether interest on loan from related parties would be allowed for working capital purposes, it appears so. If it's for working capital purpose, it appears so. But because it's a related party transaction, you will have to, that interest needs to be at arm's length, needs to be at market value. It cannot be below that market value. So if it's not at market value, again, there would be a transfer pricing adjustment to that income. Does the funding, the maintain balance between two related parties under view of TP does? Oh, I don't understand. I think you mean that, you're asking that if there are any thresholds in terms of shareholding for transfer pricing, in terms of, I mean, not shareholding perspective, but you mean a capital that has been invested into the entity? No, only a shareholding condition has been mentioned that if two entities are held by the same person by more than 50% or more, so you would be covered by TP. Doesn't matter how much share capital is invested into each entity. Would salaries be covered under arm's length? Yes, if you are paying a salary or a remuneration to your director is a connected person, it would come under transfer pricing. But to normal staff salaries would not be subjected to transfer pricing because staff is a part of the existing company and also not considered a connected person. But yet those salaries, obviously, you would have to look out for that those employees are part of the same company and those expenditures are incurred for that company itself. If it's an employee of another group entity, the deduction will not be allowed for that salary paid. Please elaborate with withholding tax payment. I think for now, withholding tax does not apply. But as an example, say you're paying a rental income to a party, while if the rental payment is 100, you would withhold, say 2 and pay the other party 98, while 2 you withhold and pay as a payer, you withhold that 2 dirhams and you pay to the government. Should records be physically kept? No mention as to how they are supposed to be kept, but in VAT, electronic records are suffices. I think even for corporate tax, electronic records should be okay, but we need to wait for further regulations. Any legislation on depreciation expenditure? No. Right now, how an entity would be able to, and at what rates an entity would get depreciation has not been mentioned. We need to wait for further regulation and clarifications on that. It's a quite an open point. Yes, CT register. I've got a question that CT registration is different from VAT registration. It is different. For all the other questions, we can take it forward individually. We will individually write to you. Thank you for your time. Thank you for participating in our webinar.
After such a healthy discussion, I'm sure we have all been able to offer great clarity on the subject. However, we understand that due to limited time in hand, there are questions that remain unanswered. But with more clarity flowing in, we aim to host more such sessions in coming days and weeks. And we request you to stay tuned and register for all upcoming sessions to stay updated on the news. I would like to thank the speaker, CA Pratim Sen Gupta, for accepting our invite and delivering such an insightful session. A big thanks to each one of you for accepting our invitation and taking out your valuable time to attend this webinar. We appreciate you being here and have a wonderful week ahead. Thank you so much, everyone. Thank you for attending.
Thank you.